Now adjust the volume control so that the sound can be heard in all parts of the room.
This is the Protect Your Assets podcast.
You get the idea?
It's on the internet.
Make him the cutest that I've ever seen.
Go on.
Give him two lips like
It's like no cheese I've ever tasted.
tell him that his love
Here's the Sandman.
over Sandman.
Are you afraid of running out of money in retirement? Well, many advisors recommend that you withdraw about 4% from your portfolio each year to avoid running out of money. But did you know that this strategy could actually cause you to run out of money? Clear your schedule for the next hour as I unveil how the 4% rule could cause you to run out of income in retirement. Good morning. I am David Hollander, your host. So good to be with you this morning. This is Protect Your Assets. For those of you just joining us for the first time, welcome. You hear the jingle. People around here, they call me the Sandman. You can always email me a question. And how you do that is you send that email to questions@PYA Radio, stands for Protect Your Assets Radio.com. Again, questions@PYARadio.com. So I was just talking about this recent survey that says the number one fear of retirees is running out of money in retirement. One of the rules I've recently heard when it comes to retirement is withdrawing 4% each year from your investments to avoid running out of money during your retirement. If you follow it, it's possible to actually run out of money in retirement. And that's why you need to listen to the entire show today, because we're going to discuss what is called the 4% rule. Now, let's get started. Well, another interesting week in the market. You got the Dow Jones down 2%. You got the S&P off 1.6. NASDAQ down 1.3. Year to date, NASDAQ's almost off 5%. You got the MSCI International Index, which was looking so strong till now, off 1.1%. this past week. And you got the 10-year Treasury around 4.28%. But the big story, you guessed it, it's oil, and oil closed Friday at 98.65 a barrel. Anyway, this past week we had WTI crude futures approaching $120 a barrel at one point early in the week. And then that started to come back down again once President Trump said that the conflict should end soon, and that to help stabilize oil prices, we had the International Energy Agency, the IEA, announce a coordinated release of about 400 million barrels from the strategic reserve. We saw also international markets like Europe and Asia, who really rely on imported energy. Well, those have declined about 8% or more in some regions because of their energy needs and lack thereof. So a positive note this week, we saw the cost of housing inflation in the U.S. Well, it rose 3.2% year over year, but that was the slowest annual increase since 2021. That's what we're talking about today. This is a good conversation for today as you're thinking about setting up income in retirement, particularly if you're looking at retiring soon or even this year. What are you going to do with your money to make sure that it creates income for you? Well, you definitely need to set up a plan. You need to think about what you need to do. And if you are considering retiring anytime soon, well, with what's going on right now, stick with me, because we're going to go through some specific steps you might want to think about right now. You're listening to the Protect Your Assets Show with David Hollander. I am the Sandman, and we'll be right back.
Times are changing. Some would say they've already changed. And how do you actually protect your assets? David Hollander's Protect Your Assets events focus on common financial concerns that individuals and families face in retirement. Things like how to prepare for unexpected medical expenses and ways to create income to help support your desired lifestyle. Join us at our next free event to learn how addressing these concerns can help you feel more confident about the days ahead and help you sleep better at night. Just go to PYAevents.com pyaevents.com and reserve your seat today. That's pyaevents.com and sign up or join the wait list today. pyaevents.com. Now, back to Protect Your Assets with David Hollander, the Sandman.
Welcome back. I am David Hollander, and another celebrating the St. Patrick's Day weekend. Well, I guess St. Patrick's weekend we should call it now. I am David Hollander, also known as the Sandman, and you're listening to Protect Your Assets. And did you know that we are now the official sponsor of the Giants baseball broadcast? Many retirees are told to follow outdated rules of thumb, like the 4% rule, for withdrawing their money from their retirement account. So if you aren't familiar with what's called the 4% rule, it basically says that you won't run out of money as long as you withdraw about 4% from your portfolios adjusted for inflation each and every year of your retirement. This rule, it was created back in the 90s, and it was based on stock and bond returns over a 50-year period of time from 1926 through 1976. And it made sense to many for a while. But times change, and boy, did they just change a lot these past few weeks. Didn't they? You think about investing, and for one thing, the 4% rule, well, it came about when interest rates were much higher than they are today. Back then, you could get a treasury note that was paying 6% or more. And as you know, we just talked about this, the 10-year treasury, well, it's barely over 4%. So that means many older investors are looking to stocks or other ways to make their money, and often they're taking more risk. And so that's right. If you're trying to get more return, maybe you're looking at things that if and when the market comes down, you could lose a substantial portion of your principal. These types of strategies may work out great when the market's been good, like it has been the last few years, but when there is an occasional dip like we're seeing right now, and that's the question, is this setup right now that we're experiencing, is it anything like a year ago? Think about it. About a year ago, remember, tech stocks were off over 20%, and we had the market looking like it was going to be in big trouble, and all of a sudden it came back. And right now, the setup is similar. There's a lot of similarities if you start to look at last year, what was going on compared to now. And then you add to that the war with Iran and the price of oil we just saw this past week. So those are some more weights, if you will, causing this stock market to pause. So if your plan is to withdraw, say, 4% from your retirement accounts each and every year, and we have that drastic drop in the market that at some point could happen. And this past week, I was surprised when I was reading through the research reports I usually read, and I saw something there from a Bank of America analyst who was talking about 2008 all over again, and how oil could go to $140 a barrel, and how private equity might be the canary in the coal mine again, on and on about these sort of things. So anyway, if oil were to stay at $100 a barrel or more for a while, and you are taking, say, 4% out of your portfolio, that is made up of equities. A lot of people have equities in their companies. And what would happen if that were to occur? Well, let's say your company stock was to drop a third or even 20%, and you had to sell off shares to create income. That's what I'm talking about. You see, when the market starts to drop, if you're just retiring or you're already in retirement and you continue to withdraw the same amount, you're going to have to sell more stock than you used to get the same amount of money, to get that income you need on a monthly basis just to pay your bills. You may have to reduce your withdrawals, you might have to change your lifestyle, or you might actually just run out of money. And so, you know, we've seen this happen. And right now we are talking about some clients' experience. We were not compensated for sharing this. This experience is not representing all clients, and the results I'm talking about right now, they're not guaranteed and will vary based on everybody's individual circumstances. But these things do happen. And so those folks who have built, say, a concentrated position in their company's stock that could be tech related, and now they're looking to retire, and they've done so well these last few years. I mean, let's face it, the tech market has really rallied pretty nicely, and you're sitting on a big portion potentially of a portfolio. And now all of a sudden these things are starting to happen, and we're seeing the pullback start. And so, that could certainly affect the income that you're going to be drawing on once you retire, particularly here in the Bay Area. And so if you're lucky enough to live longer than you think you might live, or your spouse might live longer than you think you both might live, then you're going to need to add an increased longevity expense and inflation factor to how you go about withdrawing money out of your account. And that's where the tools that we use, like e-money, you might want to look those up. E-money is something that we use, and it's a very effective tool that looks at all of your accounts, looks at inflation that you can adjust to what you feel is accurate, and then it also integrates your portfolio and your expenses and your income and your taxes and your rentals, if you'd like. All those things can go into that, and you can map out the future with what you have coming in and going out. And if you're not doing that and looking at it regularly, then you're taking a risk. It's just really that simple. And right now, with inflation seemingly starting to come back, again, that's the fear right now with the higher price of oil. If oil stays above $100 for a period of time, that should, typically in the past, it's translated into what we pay for different things that are related to oil. If you think about it, oil is in a lot of things that we consume daily. And so if those prices stay elevated, well, of course, it's going to make things cost more. And that's plain and simple inflation. And if you add to that longer life expectancies, etc., how are you going to create that income over these next few years as things just end up costing more? I mean, it already feels like they cost a lot more right now anyways, doesn't it? But then you add to that, on top of that, what's going on, and it could just mean higher prices for longer. So again, with the Treasury yield on Friday, just about 4.28% on the 10-year note. And you've got yields moving higher primarily because you've got the currency and the bond markets pricing in these higher prices in the future related to the oil. You got higher potentially inflation coming again, and maybe not the rate cuts that we were planning on. Again, they're going to meet this Wednesday. We're going to hear what they have to say. So will inflation come back and be higher later this year? It's a great question. And it's something that you have to think about, particularly if you're planning on a certain amount of income each month, and you're going to want that income potentially to even increase because of those factors. And so just be aware of that. Make sure you build that into your plan with some sort of a cushion if things change. Now, what other things should you be thinking about as you start to look at retirement? Well, here's something that's sort of out of the blue. I mean, we've got now the new big, beautiful bill. It's been the law now for a bit. You're doing your taxes right now. The IRS just said that the refunds this year are up better in our favor, I say the taxpayers' favor, by about 9% in terms of what's coming back compared to last year. And so will taxes get higher at some point in the future? This is my personal opinion. I think taxes will be higher later, certainly in the next, 5 to 10 years is what I would say. And why do I say that? I'm going to have you go take a look at something called the USDebtClock.org, USDebtClock.org. This is a super interesting website where they have things like the U.S. national debt. You'll see these things moving as quickly as tenths of seconds. They just keep mounting. You see the tariff revenue, you see the debt per taxpayer, and you can go back and look at historical rates, which is kind of interesting. They have this thing called the time machine. And so right now, just to give you an idea, the debt per taxpayer right now is $356,089. What was it just 26 years ago in 2000, you asked? Get this, the debt per taxpayer was $55,398. Think about that. That's a big difference, isn't it? And why is that? Well, it's because of all the things that are going on in the world. And so if you want to know about your Medicare, if you want to know about the trade deficit. You want to know about savings per individual. The average savings per taxpayer right now, $336.29 per year. You can see the changes that are going on. It's a very interesting gold. It's all there. I'd take a look at it. Anyway, this is a super interesting website. And when I look at that, what it's telling me, again, just looking at the historical numbers there, is that taxes that we're going to owe as individuals, if we pay taxes, are just going to be going up at some point. And of course, fees that you pay as well. You know, how much are you paying in fees to manage your money? You should know about those things, because those do eat away at your total return. And so if you're not making the kind of returns you need to make, like we were talking about here with this 4% rule, maybe you're taking more risk than you otherwise should, because you're trying to make that up by return. So that's where you start to ask yourself, well, is my lifestyle that I'm living now in retirement, or that I want to live in retirement, is it at risk? And if my portfolio doesn't produce enough income or enough growth to cover those expenses, what's going to happen? You don't want to find that out in the middle of what you're trying to do, like retire. How will you cover your bills, and where should you take the necessary money from if you're lucky enough to have choices? Maybe you have an IRA account, maybe you have a Roth, maybe you have rental real estate with equity in the ground, maybe you have what we call non-qualified accounts. These are all things you have to consider. Maybe you have Social Security. When do you take these things, and how do you take them? What's your strategy? These are all very good questions that we see daily. And the first thing that I would recommend you do if you're faced with these decisions, or if you're in the middle of them, is pick up the phone and call me and get a second opinion. For over 30 years, we here at the Liberty Group, we've been helping anyone in the Bay Area who wants a second opinion. That's because, remember, we are estate planning attorneys. We have tax professionals that we work with. We have a full-service financial firm where we do stocks, bonds, mutual funds, you name it. We look at all of those things. It's all under one roof. Give us a call, 866-PROTECT. The number to call, 866-776-8328. You give them a call, 866-PROTECT. Coming up next, it is time for our popular They Say segment, where they say if the 4% rule worked all these years, why won't it work in the future? And you're listening to the Protect Your Assets show with David Hollander, the Sandman. That's me. We'll be right back.
Take the first step toward reaching your financial goals and get the information that can help you live a confident retirement. That first step is going to pyaevents.com and signing up for our next free event. That's pyaevents.com. Now back to Protect Your Assets with David Hollander, the Sandman.
Welcome back. Happy St. Patrick's Day weekend. I am David Hollander, also known as the Sandman, and you're listening this morning to Protect Your Assets. And did you know that we are now the official sponsor of the Giants baseball broadcast? The financial and investing world just got so much more complex this past week. So much so that people can become frozen, or they end up making mistakes or just missing out. And so, you know, this past week we saw the price of oil go over $100 a barrel once again. It closed below that, but everyone's asking the question, what should we be doing with our money market accounts that are earning maybe less than 0.25%? Now it's time for one of our fan favorite parts of our show. It's our They Say segment, where we debunk common myths, half-truths, and sometimes just bad advice that they say.
Who are they? What do they know that I don't? And what are they saying this week? Here's David Hollander, the Sandman's answer.
All right, so here's one they say. They say that if the 4% rule worked before, then why shouldn't it work again? Well, we've been talking all morning about this 4% rule, which basically says that as you retire, if you take out 4% out of your portfolio, you should be just fine. But to answer the question, the 4% rule, it's over 30 years old, and a lot has changed over the last 30 years if you think about it. Think about it. 30 years ago, we didn't even have an iPhone. Years ago, a top retirement researcher wrote about the differences between the market environment when the 4% rule was created and now. It's been more than 10 years since Wade Pfau, who was one of the top experts in retirement research, he wrote a column for MarketWatch urging readers to say goodbye to the 4% rule. In it, Mr. Pfau suggests that the rule, which is more of a theory really, made too many assumptions based on old numbers that didn't necessarily translate to modern markets or modern investing. A few months later, in 2013, Mr. Pfau and fellow retirement specialist Michael Fink and David Blanchett published another study. This was called "The 4% Rule is Not Safe in a Low Yield World," further demonstrating why advisors who base their clients' withdrawal plans on historical data could be doing a disservice. Since then, the topic has been debated in many financial forums, and we've talked about this over the years. Not everyone believes the 4% rule must be completely discarded, but I think a lot of folks who work on retirement like we do would say you got to think about it a little differently, because at most it is a guideline or a starting point for determining what's appropriate for your specific needs. Everybody has their own specific facts and circumstances, and really it shouldn't be a hard and fast one-size-fits-all approach. And yet I still hear from people getting near to retirement or pre-retirees thinking about using the 4% rule without any questions to determine if it's sustainable, if their portfolio, their specific stock portfolio right now could work. So let's look at some of the facts discussed in the study. The safety of a 4% initial withdrawal strategy depends on asset return assumptions. And fixed assets like treasuries, for instance, the rates on those have declined. And if you add to that, the intermediate term real interest rates were about 4% less than the historical average used in previous simulations if you go back to 2026 when rates started to rise. And so that's why you need to look at what you're doing right now. And if you're about to enter retirement, certainly take a look at how you are set up to enter retirement. And so if your program or your tool or your spreadsheet or whatever you're using, maybe you're just throwing it against the wall, I would recommend taking a look at a tool that we use called eMoney. eMoney is a program that can integrate many different accounts that you're using, different tax strategies, different interest rates, different inflation simulations you can run. It can help you map out what your plan could look like here in the future, and you could stress test it on top of that using another tool we use called Nitrogen, whereby you can stress test the portfolio and see how it might act in different market simulations that we could experience. It got my attention this past week when I heard a Bank of America write an article about 2008 all over again. So anyway, you can go ahead and get a second opinion right now or get an illustration from us. We're happy to run these simulations for you to see what is going on. Pick up the phone, give us a call, 866-PROTECT, 866-776-8328. Time for a quick break, but when we come back, what's the one thing you can do to make sure you have income each and every month in retirement? Well, that answer is coming up next. Keep it tuned right here to protect your assets. We'll be right back.
Times are changing. Some would say they've already changed. And how do you actually protect your assets? David Hollander's Protect Your Assets events focus on common financial concerns that individuals and families face in retirement. Things like how to prepare for unexpected medical expenses and ways to create income to help support your desired lifestyle. Join us at our next free event to learn how addressing these concerns can help you feel more confident about the days ahead and help you sleep better at night. Just go to pyaevents.com and reserve your seat today. That's pyaevents.com and sign up or join the wait list today. pyaevents.com. Now back to Protect Your Assets with David Hollander, the Sandman.
Welcome back. I am David Hollander. They call me the Sandman around here, and you are listening right now to the Protect Your Assets Liberty Group Radio Network. And I don't know if you heard about that, but we are now the official sponsor of the Giants baseball broadcast. So on today's show, we're sharing how the 4% rule could ruin your retirement. Many retirees are told to follow outdated rules of thumb, like the 4% rule that we've been talking about today. And what that involves is how you withdraw money out of your account as you are in retirement. And the key to consistent retirement income is, as you get nearer to retirement, is switching your focus from growth to producing income. And I know it's hard to do, but it's almost like a mental shift that has to occur. And this is very important that you do that you focus on that switch and how you're going to stop dollar cost averaging into the accounts that you're doing in terms of saving and all those years you've done that, to now switching over to doing the reverse, dollar cost averaging out of those accounts and creating income each and every year, even if we happen to be in another 2008 type market again or another recession again. These things do happen over time. And depending on what you read, there's many arguments out there right now for the setup that is occurring here right now. A lot of parallels being driven to last year when markets pulled back 20+%. A lot of parallels being driven to other, not great markets. And so this is what people are talking about now in the financial circles. And so you've got to ask yourself, if you're at or near retirement, you're starting to think about, well, I've done really well these last few years in my equity accounts. That's great. And now might be the time to start planning your exit in terms of income and what that might look like. And so something to consider right now, which could create income now, 5 years from now, 10 years from now, could be something called a fixed indexed annuity that's backed by the claims paying ability of that issuing insurance company, which could pay monthly income to you and or your spouse for as long as you live. So if you need help, we can help you develop a strategy in writing to maximize annual income and look at lowering your taxes. And this is virtual. This is something that we input data into. We give you the access to it so you can see it too, real time, anytime you want, 24 hours a day. And it updates nightly. And we can look at it with you and help you map out and plan that retirement that you're getting ready for. For anyone who's nearing retirement, the income strategy often involves determining when we're going to start drawing your Social Security. Also, when are we going to start withdrawing money from your 401ks, your IRA, your pension? How are you using the rental real estate that you own? Maybe you have equity in the ground that's really not doing much for you when you really factor in all the costs associated with running that property. We do all these things with you and help you. And so now what I'd like you to do is think about what that retirement should look like. What's your ideal retirement? Right now, we will go ahead and email you out our checklist. This is our checklist, which literally takes about a minute to read through. It'll answer the questions that you might be thinking about right now when it comes to retirement, give you the clarity you're looking for. If you'd like to get that right now, give us a call. We'll be happy to send it to you. 866-PROTECT. Again, to get your retirement checklist, 866-776-8328. I'd like to give a big thanks to the Protect Your Assets St. Patrick's Day weekend team for putting together a great show today. Executive producer, network manager Kevin Renfer, and of course all my fabulous producers Nick and Zach helping out back there, because without my team, I'm just another pretty voice on the radio. Thanks again, everybody. You've been listening to the Protect Your Assets show. I am David Hollander, the Sandman. Have a great weekend and go out and make the rest of your life the best of your life.
Investment advisory services are offered through Liberty Wealth Management, a registered investment advisor. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. The strategies mentioned are not suitable for everyone. The information expressed does not consider your specific situation or objectives and may not be appropriate for all investors. Past performance is not indicative of future results. To better understand the risk associated with investing and how it reacts to different market conditions, listeners should always consult with their qualified investment professionals, financial advisors, legal or tax specialists, and conduct their due diligence before making any financial decisions or taking any action. The legal information provided on the air is not intended to substitute for callers hiring their lawyers to advise them about personal legal matters. Investments involve risk and, unless otherwise stated, are not guaranteed. Liberty Group LLC paid for the following program, and the host's views and opinions do not represent those of the station or its ownership. California Life Agent number 048569. Persons engaging the services of one affiliate of Liberty Group LLC companies should be aware that each company is operated separately. You are listening to the Protect Your Assets Radio Network.